IT Pro TV, an easy, entertaining approach to online IT training. Access over 2,000 hours of up-to-date, high-quality video content live and on demand for a free 7-day trial and 30% off the lifetime of your account. Visit itpro.tv/startup security and use the code SS30. Gain control of cyber risk with Tenable.io, the first vulnerability management platform built for today's elastic assets like cloud, containers, and web apps. Discover a fresh, asset-based approach that prioritizes vulnerabilities while seamlessly integrating into your environment. And improve ROI with the first elastic licensing approach based on assets, not IP addresses. Tenable.io delivers the data and context you need to secure your elastic attack surface. Start your free Tenable.io trial today by visiting Tenable.io. Welcome back, everyone, to Startup Security Weekly. A couple of quick announcements. Check out Wild West Hackin' Fest put on by the fine folks at Black Hills Information Security, October 27th through the 28th, featuring speakers such as Dave Kennedy, Deviant Egypt, Chris Nickerson, Chris Gates, Mike Poor, Sub-T, and more. WildWestHackinFest.com, HACKIN Fest.com. And not just any con. Well, actually, AnyCon, the first hacker conference of its kind in Albany, New York on June 16th and 17th, Albany Convention Center. It will feature a Capture the Flag, Hardware Hacking Village, ping pong tournament in a family-friendly environment. Keynote will be by none other than Dave Kennedy. Security Weekly will be there. Doug White will be doing hacker movie trivia and giving away Security Weekly t-shirts and hacker movie-themed glassware. Go to anycon.info/tickets to register using the code PAUL, P-A-U-L, receiving $25 off for that discount code. Michael, what do we have on startup and security notes of interest?
There were some things happening in the security world this week we're going to talk about, but the first thing, and I really dug this, Crunchbase put out an article called "Here's How Likely Your Startup Is to Get Acquired at Any Stage." Now, this is not specific to security, but I thought the stuff in here was absolutely fantastic, especially if you're trying to understand this. And I'm going to, again, bring it back to this theme I keep looking at in terms of innovation. We wrote last week about how the modern day venture capitalists, especially what we're seeing in the cybersecurity space, are essentially the managers of R&D. We specifically looked at it there in terms of the publicly held security companies. So the companies that have reached their exit, IPO, or acquisition into a publicly held company, we see a downward trend. It might be anecdotal, but we see a downward trend, downward pressure on your research and development budget because research and development's risky. And as a result, you want to de-risk, you want to keep doing what you're doing to make money, to return value to the shareholders. I'm going to go ahead and posit we see the same thing now in large companies. The reason we see so many large, S&P 500 companies setting up venture funds and M&A acquisition activity, right, what we call buy side, is because that's how they can innovate. That's how they can stay competitive. They can do R&D on security themselves, or they can go have a whole bunch of startups in the space do it, and then they can just keep interviewing them, and depending on where they're at in stage, they either partner with them or acquire them. So what's interesting about this, and there's a ton of detail in this, so we'll just go high level on it, is it said, okay, we looked at 15,600 U.S.-based technology companies founded between 2003 2013. And what they looked at was the number of rounds that they raised, how many of them had exits, and all sorts of stuff. And I'll tell you the two big findings. 60% of companies will fail to even get their Series A. And the other thing is the most popular, by far, way your exit is acquisition. And you and I have been talking about that all year. It's not always IPO. It's not always I'm going to remain a going concern privately. It's someone's going to come in to acquire you. And so then if you start digging into it, then, it talks about, in other words, our data section, 60% of the companies that raise seed funding, anything pre-Series A, they fail to make it to a Series A or beyond. Now, when you look into it, what happens is that those are the people that are taking the most risk. That's why traditionally we see those rounds are smaller, because people know that there's a higher risk. And what we talked about last week was the opportunity to start a startup now is so, look, if you're in it, it's not easy. But man, it's a lot easier now than it was a decade or 2 decades ago. And so it's not as cash intensive up front. You can throw an idea out there and see what got traction. And if it gets traction, then as the VC come in, they put somebody on your board, you get more of that structure, right? That structured accountability, that guidance, all that stuff that you need in order to progress to those rounds. And in a series I'm working on right now, as you progress through those rounds, your risk changes and your expectations to perform at those levels changes. So your series and A/B rounds, you're really focusing on product market fit, you're focusing on traction, you're focusing on unit economics. When we look at companies that are in their C and subsequent rounds, whether it's debt, equity, or actual named rounds, they're all about expansion at that point. At that point, they're essentially companies. They're in a growth mode. What makes them different, why they're not considered, grown-up companies yet, is because they haven't exited. So they're still getting to that escape velocity, whether that's a merger and acquisition, it's an IPO, it's a PE buyout, or it's a actual buyout, and they remain as a private concern. I was reading some research today that was talking about the distinction between private equity or privately held companies and publicly held companies, and how being a publicly held company actually creates the conditions by which you are almost enticed to act against your best interest because you have to show a short-term gain, and that private companies or companies backed by private equity don't have that burden, and so you tend to see them increase R&D and increase their supplies and inventories and take some of these risks that have a tendency to pay off. So when you look at this curve, then what it also basically said is, and you've got to read it to get into the explanation, but what it basically said is, and I might get it wrong, and if I find it here quick, I'll read it exactly. But basically, the bottom line was 92% of acquired companies had raised funds up to a Series C round. So, and they said it doesn't mean that 92% of C companies got acquired. They actually said it's if your goal is to build a company with an exit, and again recognizing the biggest exit's acquisition, if you can get to a Series C round, you got a 1 in 10 chance is actually what that breaks down to.
Fascinating, Michael. And a correction from Enterprise Security Weekly. I thought CyberArk was public. They are, in fact, public. I might have misspoke earlier on that. Because I've seen them make a lot of acquisitions.
And that's why.
And I was like, well, they must be going public. They already are public and have been since 2014. But it's interesting, their history. In 2006, they took a $2 million debt round. 2011, they took a $40 million equity round, and then IPO'd in 2014.
Yep.
Interesting journey for CyberArk.
Yeah.
And we see them swallowing up companies like left and right now. And it seems to me like they make very good decisions when it comes to integrations and acquisitions. They just bought a DevOps company, for example.
Yeah, well, we talked about it last week. They picked up Conjure.
Yeah.
And I did a bit with Udi a couple weeks ago, and actually he and I are going to talk again for a new story I've got coming up. They're really disciplined, and you know what? If I'll ask him if he wants to come on the show, if he's comfortable talking about some of these decisions and what that's like, because I mean he's the co-founder of the show, or the show rather of the program. So like he's been on a pretty interesting 15, 16, 17 year journey as he's looked at a lot of this type of stuff. But what's interesting is once you start looking at it that way, it's like, oh, okay. Now let's do a flashback to the stories we just talked about on the earlier part of the program today. So if you're looking for problems to solve, I think you hit it pretty well, and you said it's okay to be specific. Yeah, just realize it doesn't mean you're gonna go through rounds and rounds and rounds and rounds and then be acquired. I mean, I'd have to go look up Conjure, but Conjure got through past an A at least and got acquired.
Yeah,
right.
It was like 43 million, right? We reported on last week.
Yeah. Yeah, in fact, I kind of frankly appreciated that they reported on it, because one of the things I've picked up from the VC and the PE folks is that's why acquisitions will tend to pay a multiple that seems a little higher than usual. It's because it's a de-risked technology. All the cards are on the table. The acquisition makes sense. So they'll pay a multiple because they didn't have to take that risk up front.
Right.
So you'll get a higher multiple for it afterwards. By the way, if you're in the startup world, recognize that. And I'm just going to come back to it again because there's a third part of this equation. It's the buyers. It's those of you in the enterprises that are starving for this innovation. As you listen to our program, as you see these things that we talk about, tell us the companies that you're excited about that you think are solving really interesting challenges, because what they need to get to that next round is that traction and that product market fit. If you're helping them by asking questions or pushing back or shaping the way that it works, and we amplify that, then that gets them more attention. That's going to be the signal to the VC and the private equity and any of the other institutional money or even M&A activity we see now saying, whoa, we should take a look at them. That will ultimately de-risk them more. So think about how this gets self-serving if you're a security leader today. I like this company. I like the problem. I've got this problem. They're helping me solve this problem, right? Creating value. I like the impact it has on my environment. Okay, cool. So at some level, though, you're going, ooh, this could be risky for me, though, because what if they go out of business? What if they don't stay? The way you help them de-risk is you introduce them around to other people trying to solve the same problem. Can't be scarcity mindset of, well, but then they won't be there for me. And by the way, if you're in a startup, I mean, take care of the people taking care of you. But that's how you signal to the marketplace that, yep, this is the one, this is helping, this is making sense. And as that traction grows, then they get de-risked, and you've got a much better shot of them sticking around and being useful to you. So anyway, I thought it was really interesting. Obviously, I tend to geek out on these things, and I really enjoy looking at that interplay. But as you pointed out, Paul, once we look at it, and like, oh, well, they're at a Series C. Okay, what does that mean then? It means that they're in a growth stage. And then we can go dig into, so what does their path to growth look like? So this should also start to influence the questions that we ask of our guests based on the stage of their startups.
Yeah.
And I'll ask Udi if he wants to be on the show. That'd be great.
Awesome.
He's fun to talk to.
Karamba.
Right, yeah, I got to tell you what, I hadn't heard of them.
No,
and so like you talk about picking up a series, they picked up a Series B, 12 million. It's not a small Series B. I mean, that's pretty sizable. And what's interesting too is that makes their total raise to 17 million. So, that's, I'd have to pull it up quick. But that basically, it's like a $1 to $2 million seed round, a little bit bigger, and then they get a $12 million big round. It's got some big names behind it, but here's the interesting thing that I thought, and I was kind of curious your just big take on it, was they're looking at car-connected technology, and if you look at one of the headlines, it says they have hack blocking technology. And we're seeing more and more that, frankly, I see a lot of startups going the other direction. We're gonna tap into the
OBD2 port.
Thank you. Sometimes language gets in the way. And we're gonna connect it up to the network, and we're gonna do all this other type of stuff for you. Good luck, congratulations. And they're saying, no, we're gonna find a way to handle this. And then of course this gets lumped into autonomous cars and whatnot. Do you think this is a space that we're going to see more activity in? People looking at solutions for cars, both the ones we still drive as well as the ones that will drive themselves?
Yeah, I think it's I think there's a lot of events that have led up to that. Certainly, I think car manufacturers don't want to be the next Jeep. I think that it's in the beginning stages of maybe entering in people's minds when they purchase a car. Although I think we're a ways away from that now. I also think that government regulation and standards and guidelines is going to push, car manufacturers to secure their technologies, and I think there's going to have to be companies that help them with that problem. So.
Well, yeah, and if we go back to it, right? So let's say let's look at it in the context we start looking at stuff now today. You're a car manufacturer. In fact, I've got a friend at a car manufacturer looking at these types of things, and they're talking to startups every week. Not just for security, but his role is security. And he's talking to security startups every week because they're constantly looking for partners or solutions to either problems and this is what I really dig, problems they know they have and problems they don't know that they have yet. And so they're keeping their eyes open for it. So if you can be part of a huge organization that even says we like R&D, we're going after it. Everybody today is paying attention to what startups are doing because that's where the innovation comes from. That's where those ideas come from. And if you've got one that's good, then the question is just how do you get that signal out? How do people see you, recognize you? What's the flair that attracts them? And as long as you're focusing on the ability to explain the problem you solve, right? And here's why it's so important. Because even looking at this, I looked at what they did fast. I didn't really get it. I probably should go look a little deeper into them, and frankly, probably should have prepped a little bit better before this, and I apologize. When I talk about isolating and elevating the problem, you got to get it down to that nugget, and when you elevate it, it's asking it in a phrase that the brain just locks onto. I am somebody who loves positivity, but the reality of the way that our lizard brains are wired to keep us alive is we look for threats. And we have things in our brains that we worry about. If you phrase a question, now the cool part is the question doesn't have to be negative. But if you phrase the question right around the problem, that's called elevating the problem, the brain locks onto it. So you tell me that I can't get people's attention. That's because you're leading out with your feature set. That's because you're leading out with what you think you do. That's because you think you're giving me a value prop by telling me how awesome you are with a bunch of words that I don't understand. If you get this process right, you engage that attention by elevating that problem and asking it. Now, once you do that, boom, they'll keep sticking around. And so like when we talk about value prop, if you do that and you can show me quickly that you create value for me emotionally, right? Qualify it and quantify it, and that the impact is positive, not negative, I'll ask for more. That's when you tell me how. That's when you sell me on process. That's when you talk about your methodology and everything else. Prior to that, last tip for now, the inverse of the problem is the solution. So like if the problem is I need to put a hole in the wall, it's this drill will help you put a hole in the wall. Not this drill has all these features and all this great stuff and this bad. No, they don't care. They want a hole in the wall. Now, if you're telling them you can help them do that, cleaner, better, faster, great. That's the kind of thing. All right, what do you think of security unicorns?
Yeah, they're definitely a security unicorn.
$100 million. They raised $100 million this year. They're now they're $1 billion valuation. $100 million. It's a Series D. That puts them in serious growth. I got to tell you, I still don't understand what Crowdstrike does.
Yeah, I'm in that boat.
I'm fascinated by it. I mean, I'm even reading it here, and it says, okay, so Crowdstrike investigates data breaches and their endpoint and intelligence and investigation, and it's a...
Well, they've got Crowdstrike Falcon, which has subproducts of Prevent, Insight, Overwatch, Discover, Intelligence, and DNS.
Right. Yeah. Okay. And they're doing a cloud-first model for security. So, I mean, it could just be I'm not smart enough, or I'm not in that space, or it's really good. I think... I'll tell you what. If you got knowledge of it, light us up. Let us know. I mean, I'm happy to be educated. There's no animosity here on my part. It's a simple. I look at value prop stuff and I struggle to explain it. Obviously, they're showing good numbers to somebody to get this kind of valuation and to get this kind of money. Somebody's taking a bet on it.
Yep.
And so that's a signal to enterprise people. It might be worth taking a look at. If you're one of those enterprise people, I'd love to know the problem it solves. Help me understand it better, and I think we're in really good shape. Last one of the week, Wandera. Wandera? Is that how you say it?
Yeah, they seem like they're in the same boat, Michael. Enterprise mobile security threat detection and content filtering and data management services. Those are all like different things. And some of their competition lists, Mobile Iron in the mobile security front. But then like threat detection, and content filtering, that's like a whole different silo. I don't know.
Yeah, no, I'm with you on that. So again, right, Series C round, $27.5 million Series C. So again, what we know now looking at it is this theoretically tells this size and at this stage, they are in growth stage. They ideally have product market fit down and unit economics down. It means they know what it costs to produce. They know what it costs to deliver. They should at this point know customer journey map, lifetime value of customer, all sorts of other stuff. And that money is typically we need to expand. So it's going to be Salesforce, it's going to be marketing.
Yeah, and it looks like they've been expanding, Michael. If you look at their funding history, I mean, since 2012, almost every year they've taken money. They had $1 million, 1,000K. I'm assuming that is that $1 million? I'm assuming that's $1 million seed round. That's kind of weird how they put it there.
Weird.
They took a Series A for $7 million, an equity round for $3 million.
That's a huge Series A.
Yeah, and then a Series B for 15, and now their Series C at 27. And this the only year they skipped was 2016. And I gotta imagine they've got customers that are paying them, money for their products and solving problems. So
yeah, what's interesting in this too is that if you look at it's interesting when you look at the history. So the other conventional wisdom is your Series A needs to get you through product market fit, or at least to a pretty good product market fit with some pretty good unit economics. And on average, that's going to take about 2 years. By the way, right? Go look at the article we broke down last week, episode 39, where we said, okay, how long does it take to get product market fit? And on average, it's an 18-month to 24-month to sometimes 3-year journey. So what's interesting is after getting their Series A, it's a pretty big A, they got another $3 million equity round from the same investors. So it was almost like they needed that little extra before they were ready to get to that Series B. And if you'll notice, Bessemer Venture Partners has been involved the whole way. So that also means they likely have helped structure this and have helped shepherd some of the other people around it. So, what I'm also starting to realize is sometimes the reason these don't pop up on us is because these companies, they've built their own networks. They have their series of advisors in the companies that they bring these technologies around to. And I think that's one of the roles that we play, is that we can help cast a light on these. So if you worked with Wandera, let us know. Let us know how you're using it. And again, I'm always going to be curious in what problem is this company solving for you? What value are you getting for it? And talk about the impact on installing it, integrating it, using it in your environment, because that's the kind of stuff that I get pretty excited about. So those are the biggies there. I got back to writing this week. I started a series on cyber insurance. And I got to tell you, Paul, it's been a blast. I have, coming up 6 parts. I've talked to insurance carriers. I've talked to risk managers. You're going to love this, and I'll tell you about it more when it happens. Worked with a risk manager, can't name the company, but they went from, we don't need any of this cyber insurance stuff. We don't have that as a risk. Their business shifted. It was an exclusion and a policy. As a result of it, they created a new risk product, a new risk market, and that drove the need for the CISO. They created a new security team, and they created a new security council, and they've completely changed their whole business. So I know a lot of people poo-poo cyber insurance. What I've realized is that's cyber liability insurance, and that's what happens in the event of a breach. What I can tell you is that's not the only way, and this series really educated me. So we're sharing that, and it's been really a lot of fun.
Awesome, Michael. We're running short on time, so.
Oh yeah. So I'll make this tight. I've started offering the value prop breakdown to people, and so here's my epiphany of the week as part of my journey. I found again I was getting a little too excited about getting everything right, and so what I've got is a 18-point rubric, a variety of ways to use it. Figured out as a progression, stuff I've already shared. So a couple of you reached out to me, and I'm setting up those calls, and we're working through stuff. And the new thing today is I've got a mind map and a partial outline, and I'm just going to share it with people. And I'd say over the next 2 or 3 weeks, anybody who wants to work through the value prop breakdown with me, wherever they are at the stage, they get up to an hour, we crush it, pull the stuff together, and then that should help me build out all the materials. So it's kind of like not quite crowdsourcing. And, I don't know what it is, but we're going to see how it works out. Been some great clients helping me get better, helping them get better. Life is good. How about you guys?
Fantastic. Not much has changed since the last update on our journey. We're still plugging away, working with initial customers, and getting ready to get our stuff out in Amazon AWS Marketplace. So more on that next week. Thank you, everyone, for listening and watching Startup Security Weekly. We'll see everyone next week.